Every single time the stock market takes a tumble, you'll hear the exact same phrase echoing across the internet, financial news, and probably from your coworkers. It honestly happens like clockwork. People get incredibly excited because prices are falling, and this massive frenzy begins. But what if that universally accepted piece of financial wisdom is actually the wrong advice for most beginner investors? Buy the dip. I mean, it sounds so intuitive, right? The idea is incredibly simple and frankly very tempting. If a company's stock was selling for $100 yesterday and today it's suddenly selling for 80, well, it feels like you're getting a massive bargain. It feels like great advice. You buy it at 80, you wait for it to bounce back to 100, and boom, you make an easy profit. And sometimes that is exactly what happens. But for everyday beginners who don't spend their lives analyzing financial statements, blindly buying that dip can be a massive trap. There are 3 clear reasons why the calm, methodical approach of the illiterate investor deliberately avoids chasing these market dips. Let's start with reason number 1. A lower price just doesn't automatically mean a better investment. See, when you buy a dip, your entire strategy relies on hope. It's the hope that a stock will eventually recover its lost value. But for buying the dip to actually work out, you need to know exactly why the stock fell in the first place. Are you looking at a fundamentally healthy business that's just facing a temporary setback? Maybe some short-term bad news scared off a bunch of nervous traders? In that case, the stock is just temporarily out of favor. Or, on the flip side, is the business actually getting fundamentally weaker? Are sales plummeting? Is new competition destroying their market share? If so, the stock price has dropped because the company is genuinely worth less. Those are 2 radically different situations. Pretending you know the difference between a temporary setback and a failing business just because the stock chart looks cheaper is, well, it's incredibly risky. Think of it this way. You would never buy spoiled food at the grocery store simply because it was 50% off, right? The price tag is lower, sure, but the underlying product is bad. Blindly buying cheaper stocks without actually understanding the company's financial health, their earnings, or their competitive position, that isn't investing. It's just speculation. Moving on to reason 2. No one actually knows whether it's a dip or a falling knife. When a stock drops 20%, it really feels like it must be at the bottom. But here's the harsh reality. A stock doesn't have a floor. A stock that has fallen 20% can easily fall another 20% and then another. In the financial world, trying to guess that bottom is called catching a falling knife. It's the act of trying to buy a stock while its price is in a rapid freefall, hoping you perfectly time the absolute bottom. But just like trying to catch a real falling knife in your kitchen, you're far more likely to end up bleeding, or in this case, facing severe financial losses. The inherent danger here is that a healthy, temporary dip and a catastrophic falling knife look almost identical while they're happening. In the heat of the moment, chart A, which is about to rebound 30%, looks exactly like chart B, which is about to collapse another 60%. You simply do not know which chart you're buying into at the exact moment you click buy. So, the crucial point is this. If highly experienced investors, Wall Street analysts, and professional fund managers who spend decades studying earnings reports get this wrong, why should everyday beginners pretend they can predict it? Attempting to guess the bottom of a market drop is an incredibly difficult game, and frankly, it's one that beginners just aren't equipped to win. And that brings us to reason 3. Never make investment decisions because of a fear of missing out. When the market dips, the emotional pressure can be absolutely overwhelming. You see headlines screaming about once-in-a-lifetime bargains. You see friends bragging on social media about the cheap shares they just scooped up. You might even start getting literal phone calls from people saying, buy it now, you're going to miss the opportunity. The danger here isn't just about the specific stock, it's about the mindset. FOMO creates this frantic, anxious urgency that pushes beginners into abandoning their long-term plans to make rushed, highly emotional decisions. And let me tell you, fear is a terrible financial advisor. Whether it's the fear of losing money or the fear of missing out on making money, acting on that emotion is dangerous. Successful wealth building is completely contrary to this. It relies on patient, disciplined, and logical decisions, not reacting to sudden excitement or sudden panic. So, what's the alternative? Let's talk about dollar cost averaging. As experienced investors struggle to successfully buy the dip even after spending years studying businesses, what is the everyday beginner actually supposed to do? Well, the illiterate investor uses a much calmer alternative called dollar cost averaging. In plain English, this simply means investing the exact same amount of money consistently on a regular schedule, completely regardless of what the market is doing. It is the absolute perfect antidote to the stress of market timing. You don't look for the dip, you don't look for the peak, you just stick to the schedule. Let's break down the beautiful simplicity of this repeatable strategy. You invest when the market is up. You invest when the market is down. You invest when the market is doing absolutely nothing and just moving sideways. By automating this process, you completely remove human emotion from the equation. You honestly no longer care about the daily headlines because your strategy remains exactly identical no matter what they say. Dollar cost averaging is often compared to planting seeds instead of trying to predict tomorrow's weather. You don't need to know if it's going to rain tomorrow to know that a garden needs seeds to grow. You just keep planting. Week after week, month after month, anchoring your strategy in patience and consistency, and ultimately letting time do the heavy lifting for you. And to make this even simpler, the Illiterate Investor combines this consistent schedule with broad index funds. Instead of trying to guess which individual stock is going to bounce back from a dip, you buy a fund that owns hundreds of different companies all at once. You aren't gambling on one single company's recovery, you're simply betting on the overall creation of value across the entire economy over time. You don't need to guess the winner, you just own the whole race. The simple lesson here? Consistency over shortcuts. Building true wealth isn't about making one single, perfect investment by magically timing a market bottom. It's about making enough good, solid, disciplined decisions over many, many years. Which brings us to the signature philosophy of the Illiterate Investor. Income pays for today, assets pay for tomorrow, patience builds both. It's a brilliant reminder that slow and steady is often much faster than constantly chasing the excitement of the next big shortcut. True financial freedom is built by ignoring the noise and just letting consistency do the work. So I want to turn this over to you. Looking at your own financial journey, have you ever given in to the FOMO and bought the dip? How did it actually work out for you? Or do you prefer the calmer route of investing steadily every single month? Let me know your thoughts and your strategies down in the comments.